Hello viewers, greetings from Lotus Dew. There has been a lot of proliferation of ETFs or exchange traded funds, and most of the exchange traded funds in India are passive, but there are also many passive mutual funds. So one of the questions that is often asked is, well, what's the difference? When should I go for ETF? When should I go for index funds? How do I distinguish between them? In the previous videos, we have discussed how ETFs are part of the equity asset class in mutual fund. In this video, we are going to take a deeper dive into ETF as a vehicle in terms of getting access to mutual funds in equity. About us, Lotus Dew, we are a investment advisory based in India. We have a license from SEBI to offer investment advisory. We also have a license from US SEC. We are founded by experienced investors who have managed multi-billion dollar portfolios both locally and globally. Let's distinguish between ETFs and mutual funds. So for example, ETFs or exchange traded funds by definition are always listed. And when they're listed, they are quoted by brokers and market makers where they have a bid and ask. At any given point in time during market hours, an ETF will have a bid and ask, and you can purchase an ETF like you would purchase a stock just by trading it on an exchange through your demat account or your brokerage account. A mutual fund does not have a bid ask. It's given net asset value at the end of the day. They do not have an intraday NAV, so at a given point in time during the market hours, you don't know if the value of a mutual fund has changed, but for an ETF, you know that. And it has both its advantages and disadvantages, which we'll go into. Technically, an ETF can have unlimited purchases and redemptions. So can a mutual fund, but usually for mutual funds, when you subscribe more than 2 lakhs, they might not give you the NAV of the same day, but might give you a T+1 NAV. And second is when selling the mutual fund, because these are equity mutual funds, the settlement is T+2. So after you sell, your money is actually available in your bank account after T+2 days. Again, this is not cash, you can't withdraw it, but you can use this margin to trade into another ETF that you want to purchase. ETFs do not have exit loads, whereas mutual funds do. The main advantage here is that you do not have an exit load. Quickly, you'll see that ETF is more useful for positional bet which are short term in nature, because you can step in and out without exit load. We'll come to the details of this. Again, TER or total expense ratio for ETF is pretty low. So is true for mutual funds which are passive in nature. But the main difference here is that you have to consider a net of all costs, which we'll calculate and compare between these two ideas of passive investment. So here is a sample order book of a ETF. As you can see that an ETF has a market depth in terms of having a bid and ask and having an order book which has to be filled, which is quoted by market makers in the market. If you take the first row of the bid and ask for a quantity of 136.85, there's a bid price of 136.85 for a quantity of 9 ETF units, and there's a ask price of 136.99 for a quantity of 1, which roughly means the bid price is for selling your ETF and ask price is what you would pay to buy. So therefore, for a 1,000 rupee transaction, as you can roughly see, 0.15%. So the cost of an ETF really is the cost of stepping this bid and ask plus the total expense ratio of the fund. Main point to consider is that you're not buying only for 1,000 rupees, you might be buying for more, and then the cost starts to escalate quickly, because as you can see, the order book, if you're filling over a period of time, or if you make a large purchase, the order book will be filled at different price points. The total bid quantity and total sell quantity that you can see gives you a rough estimate of what's the total liquidity available in the market if you were to just take the whole liquidity. The actual cost of acquisition might be substantially higher than the real tick that you see. So that's one key consideration you must consider. Now we'll focus a little bit more on this calculation, and with the calculation you can see that the top 5 bid and ask, the average bid price is 136 and the average ask price is 137, and the bid ask spread is about 1 rupee 13 paise, which works out to be actually 0.84% of the total average bid price. So what it essentially means is that while ETFs are extremely useful in making short-term tactical bets, you have the advantage of switching in and out of different ETFs. You also have to keep in mind when you're acquiring this, you should probably have an experienced broker who can buy large quantities for you. Keep these 2 points in mind when considering one versus another. So remember, passive exposure always comes with active decision making. Thank you, and I hope that I've made it a little clear why should I not buy an ETF when I have an index fund, or why should I buy an ETF when I have an index mutual fund. So thanks for watching, and do look out for our next video where we deep dive into other types of mutual funds like thematic, in equity, or contra bear, talk about other ETFs in the debt space, and more to come. Thanks.